All right, let's talk about the big, beautiful bill. Let's start with some of the things that will be staying the same. The first thing is the 7 ordinary income brackets. So 10, 12, 22, 24, 33, 35, and 37 are now permanent. One big thing that did change is what's called the SALT deduction, so sales and local tax. So in states like California, where we have a state tax and obviously we pay federal tax as well, we were limited to $10,000 of a deduction for all the taxes we pay and in the state for state taxes and any other sales and local taxes together. That has now gone to $40,000. So in states like New York, California, probably the Miami area, places like that, places that have high property taxes, that's going to help people a lot in that particular area. The challenge here is that this deduction is phased out for people that make above $500,000. And once you get to $600,000 of income, then it's completely phased out. So if you're somebody who is a relatively high earner at $500,000 to $600,000, tax planning is going to be majorly important for you. Considering the SALT deduction, somebody that goes from $500,000 to $600,000 means that their taxable income can increase by as much as $130,000. The $40,000 max on the SALT deduction is available to everybody except people married filing separate, which that is limited to $20,000. So there is a marriage penalty there. And the great news on this SALT cap increase is that it's actually good for 2025 as well. So you'll be able to use it this year. The problem is this is a very expensive tax deduction or tax exemption. So this is going to expire in 2028. So make sure you take advantage of it this year. The great news about this SALT deduction cap is that it's actually available for 2025. So this year it's going to help you out on your taxes if you do pay a lot of taxes. The bad thing is it's a very expensive deduction for the government to give. So it is going to expire in 2029. So it's only good for about 5 years total. The rate of the SALT cap and the income limit will be increased for inflation each year by about 1%. Okay, on mortgages, one thing that stayed the same is the $750,000 mortgage interest deduction cap. That's going to be made permanent. And prior to 2017, we had personal deductions versus just a very large standard deduction. So right now, it's about $15,000 for a single filer and $30,000 for a joint filer. That's actually a very good deduction. Prior to this, you would get a smaller standard deduction, and then you'd have personal exemptions on top of that. That completely went away. A great news for employers that provide reimbursement for student loans. Employers can now reimburse or pay for up to $5,250 of student loan payments and exclude those from income, and that's going to be indexed each year, which means it'll go up a little bit. All right, now let's talk about no tax on tips. This is a big one, especially for people like me. My mom grew up as a server. Tips are what helped us survive almost our whole life. So I know tipping is a controversial subject, but anyways, let's talk about it. So now you can deduct up to $25,000 in tips, and it applies to all taxpayers except people married filing separate. So you get nothing if you file married filing separate. So that is a penalty there. The deduction will be phased out as income is greater than $300,000 for married filing joint and $150,000 for other. Above that, the phase out is 10% of income above that threshold. So zero deduction for married filing joint at $550,000, and that's going to be $400,000 for others. So $25,000 is a very, very generous deduction there, which is going to be great for people that are getting tips. One thing to consider is what type of income is considered tips. Doesn't mean you could just shift your whole income to tips and not pay any tax on it. That's not how it's going to work. Tips have to be a standard part of your industry, so I'm pretty confident that people like servers and bartenders are going to be just fine with that. But outside of that, I could say, hey, I just want to be paid by tips only and then take that as a deduction. I don't think that's going to work. The IRS did say that they're going to be publishing a list of careers that qualify for the no tax on tips within 90 days. So that'll be coming soon. One thing with the no tax on tips is there is no income tax on tips, but it still needs to be reported because there will be FICA taxes on that. So you're going to pay your Social Security and Medicare tax on that, but no income taxes. So that's no federal tax on that, which is great. And the no tax on tips is effective for 2025, so this year. So this is going to be a really good one for people in the service industry, which are very near and dear to my heart, where I grew up. Again, my mom was a server. I was a server and bartender for many years. That's how I got through college, and even after college when I was having trouble finding a career. So that's going to be a really good one. The deduction for no tax on tips ends in 2028, though, so it's not made permanent. It is going to be for the next 4 years or so. Now let's talk about no tax on overtime. So this one as well is $25,000, and it operates the same way, where it means no income tax on overtime. Doesn't mean you're not going to have to pay any sort of the FICA taxes. The max deduction on that is $25,000 for people filing joint, and $12,500 for single filers. The income deduction is phased out for people making over $300,000 that file filing joint, and $150,000 for those that file single. Only qualified overtime counts, but the way they laid it out is as follows. It's pretty clear. Qualified overtime compensation. For purpose of this section, the term qualified overtime compensation means that overtime compensation paid to an individual required under Section 7 of the Fair Labor Standards Act of 1938 that is in excess of the regular rate as used in such section. So basically, standard policy on overtime. This as well will be applicable through 2028 and does count for this year in 2025. So that's going to be a big win for some people. All right, one more deduction to talk about here, which is the charitable income deduction for non-itemizers. So what this means is if you go to a church and you don't itemize your taxes, which I think 85 or 90% don't itemize anymore, you can still get a deduction for donating to your church or a charity or wherever you give money. And it is going to be $2,000 for joint filers and $1,000 for others. So that was lost for a little while. And that really discouraged people from giving to some churches. I understand the principle behind it. You should give anyways. But I understand also if you get a tax deduction, it does help people want to give a little bit more. So for the churches, you're going to be appreciating that. One difference here with the charitable deduction is that this will be made permanent, but it doesn't start until 2026. Okay, so it's a little different from the other ones we talked about before. So while this was a nice deduction for non-itemizers, it does take a little bit away from people that do itemize, and that's generally a higher income. So this is for people that are generally on the lower income side or just standard W-2 workers for the most part. For the itemizers, there's going to have to be a 0.5% of AGI floor for charitable contributions that must be exceeded to be deductible, and that's when you're itemized. So for example, next year, if you make $100,000 and you itemize, the first 500 will not be deductible, but then anything above 500 will be deductible if you itemize. So it's a little bit different, but it hurts the itemizers a little bit on this one. So the maximum annual deduction for the car loan interest will be $10,000. This deduction is phased out as your modified adjusted gross income exceeds $200,000 for joint filers and $100,000 for all others. So the phase out is 20% of income above the threshold. So if you filed married filing joint, you will get zero deduction at $250,000 of income or more. And for others, it will be $150,000 of income or more. So once you get past that, then there's no deduction. But if you're making under $250,000, joint filer, under $150,000, single filer, you will get some deduction and up to $10,000 of interest. And that is available in 2025. So that's going to be a good one. So they've actually, last thing here is they bumped the standard deduction. It was supposed to be $15,000 for single filers and $30,000 for joint filers. It is now $15,750 for single filers, $31,500 for joint filers. So that's pretty much everybody's going to qualify for that standard deduction. And head of household is $23,625 versus $22,500. So what that means is if you're married filing joint, the first $31,500 you earn of taxable income is going to be taxed at zero, and then you get your 10% bracket and 12% bracket and so forth. And if you're single, it's $15,750. So this pretty much means almost everybody's going to get a tax deduction here. Okay, and the final one we're talking about here, I think I just said that, but one more is going to be what they're calling the deduction for seniors, and that is the tax deduction or reduction for seniors that are on Social Security, and you have to be 65 or older, and you get up to an additional $6,000 deduction. But that deduction phases out by 6% of MAGI above $150,000 for married filing joint and $75,000 for others. So again, if you're making over $150,000, then you're going to start to get that deduction phased out. So if you're somebody that's older doing Roth conversions at a higher income level, this is going to be very interesting for us to plan for, and that's the kind of work that I do personally to help people figure this out. So it looks like the deduction will be phased out somewhere between $150,000 of income and $200,000 of income. So after $250,000 of income, it will be zero. And this is going to be from 2025 through 2028. So this is as close as the One Big Beautiful Bill gets to no tax on Social Security. It isn't quite that, but to be fair, about 90% of seniors Social Security will be tax-free. So that's up from 2/3. So before it was about 66% of seniors didn't pay tax on Social Security, and about 90% of senior Social Security will now be tax-free. So it is true that that is going to help a lot of people. The child tax credit is bumped from $2,000 to $2,200, and that will be inflation adjusted, permanent and effective starting this year. And if you watch this far, there's more to come, more details to happen. But if you watch this far, please follow me for more. I'll keep you updated with all the details you need to know about the One Big Beautiful Bill. My name is Jason Hamilton, a certified financial planner, and I'll see you on the next one.